Hey, this is Brant from TradeGuild.net. It is the 16th of September 2008. The market's closed. Interesting day on Wall Street today with the Federal Reserve meeting at 2:15 today, announcing their policy. Let's start with the video that was released last night on Trade Guild and some of the commentary. I had said the market looks very oversold. Oversold means that the market really looks like it's ready for a bounce. Nothing goes straight up, nothing goes straight down. So the market moves up and down, and it's been down so long and so much that it looks like it's ready for a bounce for a couple of reasons. I had mentioned that I had chose in my contributors letter that I had chose to keep my long positions on Monday instead of selling into the weakness, which obviously is a risk because we could have seen more weakness today and I could have been in deeper trouble. But the dominant price volume relationships yesterday suggested that we would see a bounce today. The VIX, you can go back and look at that in last night's video. The VIX volatility index from the Chicago Board of Options was up around 31, 32, 25% gain, which indicates a lot of fear in the market, and typically that's when we see bounces as well. And basically I just thought there was some more potential upside for the stock market this week. Going into the market today, let me pull up Goldman Sachs. Goldman Sachs was the fulcrum of the market today. Basically, they had their earnings before the market opened, and basically whatever would happen with Goldman Sachs could set the tone for early trading. Goldman Sachs came out with their earnings, and they reported a 72% drop earnings per share. Okay, their earnings were actually a little bit better than the consensus. They came in at $1.81 per share, and the consensus was $1.71, but they missed on their revenues, which came in at $6.04 billion versus a consensus of, I think it was $6.23 billion. So they opened down $19.50. You can see over here, this is the close from yesterday. This is the open from today. So big, massive move down. And these are moves, especially with New York Stock Exchange stocks. These are the specialists that are setting the opening price, and they're basically going to set the lowest opening price that they think it's going to trade for the day, and they're going to fade that move, meaning they're going to buy it down here, and typically it goes back up, especially with NYSE stocks, not so much NASDAQ. But what else did they have? And they were 14% down. They made a new 52-week low. The S&P 500, I'm going to pull up the spiders as a proxy for the S&P 500, opened down 2%. So that's a really big move for an index, 2%. But it actually finished the day today up 1.8%, and we'll get to that. But that's basically on the news of the AIG insurance giant bailout. AIG, the insurance giant, is really in a really bad situation, and it could affect a lot of other companies. They're about between $70 and $100 billion short on liquidity. So there's been all kinds of negotiations to figure out how they can fund AIG. Let's take a look at AIG real quick, because this is a really horror show. If you look at this chart, back here we're $45, $50, something like that in May, and here we are at $3.75 today. So in light of what was going on with Lehman Brothers yesterday and the whole AIG thing, the overnight LIBOR rate, which is the interest rate that banks charge overnight for lending, had doubled. Okay, and basically the New York Fed came out in response to that and injected $50 billion of liquidity into the market to try to combat that, as well as some European central banks also injected liquidity into the market. So when the market opened this morning, they were pricing in between a 90% and 100% chance that we were going to see a 25-point, a quarter point basis points cut from the Federal Reserve at 2:15 today at the Fed meeting. Well, the Fed surprised everybody and left the rates unchanged. So the Fed funds rate is at 2% and the discount rate is at 2.25%. I expected, really, if we look at, let's pull up the spiders again. We're going to look at an intraday chart. Here's around 2:15. So we saw some initial selling, And then we saw a move higher, which was very surprising. I had thought that the market being disappointed and not getting that rate cut would probably see a sell-off. But again, like I said yesterday, deeply, deeply oversold. We're going to look at a couple things that showed or gave us some evidence that this little rally here was going to occur. In the first of three contributors letters today, I have the contributor letter for contributors to the Trade Guild. People who drop off or donate money, they are put on a list. So I said energy, and I'll pull up XLE, which is the ETF for energy. And let me zoom in a little bit. Energy looked ready for a bounce, and of course energy has bounced a little bit. What I mean again by the bounce is nothing goes straight down. This has been going straight down for a while, and it got a pretty good move today, up 4.23%. But at 140 today, I named a couple stocks that I thought looked pretty good for a bounce, and one was BHI, and I'm going to pull BHI up. And here's BHI. Now keep in mind it was at 140 today that this market letter went out, so we're somewhere over here. So BHI closed from the time, if you had bought it when you got the market letter today, you'd be up 5% by the close. In a couple hours, you'd be up 5%. Another one was NOV, which is National Oil, another energy name down here around $50.25, closed up at $54.37, about an 8% move. Another one was Hess, that was on the list, HES, Hess. So 140, somewhere in here, $77, $78. I think Hess was up almost $9 after that call, so about a 9% move in Hess. So the contributors letter, this is the kind of thing I put in there when I see opportunities arise. So, there's opportunities to make money. So if you want to become a part of that, there's the PayPal link off to the right. You drop something in there, and then I put you on the list. That's the bottom line. So here's what we're looking at 2:30 today. The second of three contributors letters that I put out, I said I was seeing positive divergences. And let me get rid of these trend lines. And we're going to look at my 3C indicator, which I use to spot either distribution or accumulation. Now it's in yellow, the 3C, price is in green. Over here today at about 2 p.m. we see this is when the market was selling off after the Fed, a little bit of disappointment there, but you can see 3C, which should have, if it was in lockstep and selling off with the market, if there was distribution, it should have made a new low. It didn't make a new low, it started heading higher. So at the 2:30 letter, I said, you guys, I see positive divergences. Keep an eye on this because, at this point we're all expecting the market to go much lower, and it actually ended up quite a bit higher. A couple other looks at this. Let's look at a 5-minute version of this 3C chart and zoom in just a little bit. Again, here's that that low at 215. We expect to see a lower low, but instead we see a series of higher lows, suggesting accumulation. If we look at, that's the XLF financials, here's the QQQs, which are the NASDAQ 100, and here on the 1-minute chart, again, if you just keep an eye on this 2 o'clock period around here, we should be seeing this indicator making a new low. It wasn't. So this is accumulation. So this presaged, or let us know that we were going to see this move up higher. A couple other indexes we can look at real quick. The spiders, which is for the S&P 500, and the spiders, we actually saw, if I back this up a little bit, let me see if I can do this. If I can back it up so we can see what it looked like at 215. We actually got a leading divergence, meaning that instead of making new lows, this thing was making new highs. So this was a very powerful divergence. You can also see the green volume there, accumulation setting in, and the market went from being way down to closing up. So there were a lot of positive divergences. That was in the 2:30 letter, so there's definitely opportunities to make some money there.